All right. Well, team, again, I want to thank everyone for joining us here today. I know we're getting more and more folks joining around the virtual table with us, and very appreciative of everyone being on for our exciting discussion as we focus on Money Management 101 and all things relative to your personal finances. Can't think of a better topic for us to discuss and spend time talking about here during the month of Teach Children to Save. And so we've got an amazing panel that's going to be sharing information with us throughout the course of today. And as we transition to the next slide, you'll see my name and contact information. Dewey Norwood, very fortunate to be now in my 23rd year here in the industry and really excited about the discussion that we're going to be facilitating here today. I want to jump quickly over to our run of program. We've got some exciting elements that are going to be locked in here with us. So let's begin by saying Happy Earth Day, everyone. It's been Earth Week and Earth Month, and Happy Earth Day to everyone that's joining us. A reminder to everyone that this is a space where you can ask questions. So thank you so much, scholars, for the questions that have come in advance. We have over almost 700 individuals registered for today. And I know we have folks that are accessing the playback as well. So just thank you all so much for your interest. As is our custom, this is a traditional Zoom presentation, so you'll only see our team here on the screen with things. But at any time throughout today's presentation, go ahead and submit questions over to the amazing partners over at API Scholars. You see Karen's contact information here, and you can certainly shoot her over an email at any time for any real-time questions that come in. And remember the rules with this: we're never going to read your name, we're never going to say who the question came from, but we'll go ahead and present those items appropriately. From a programming perspective, we're going to talk about budgeting, we're going to talk about saving, we're going to dip our toe a little bit into some of the suggested things that you need to keep in mind relative to investing. Also, we're going to talk about protecting your money. You know, you're building a nest egg for the future. What are some of the things that you need to do to protect yourself? Well, we're also going to give you some great action items at the conclusion of the call. As always, as we close things out, we'll ask you we'll provide you better yet an opportunity to give us feedback on today's discussion. And then always remember, you have access to the playback of these sessions about 72 hours after they're completed. All of that content lives on our API Scholars YouTube channel. So a big virtual high five to our friends there at API Scholars for all the great work. And don't forget, get social with us at any time using that hashtag WFC Beyond College. Again, hashtag WFC Beyond College is the way to get connected in with us on things. So that's where we're headed. As we transition to the next slide, again, Earth Day 2021 is here. I'd encourage everyone to visit the URL that's listed here to connect in through our Wells Fargo Stories channel to hear about our sustainability efforts within the firm. And I want you to note on the bottom of the screen, Wells Fargo has pledged to align our business activities with the goals of the Paris Climate Agreement to achieve net zero greenhouse emissions by 2050. Very important goal that our firm has set forward. And I would encourage everyone to just visit the website to learn more about some of the great things that are happening relative to sustainability within our institution. The next slide, again, is just a reminder around the Zoom etiquette. You'll only see our speakers and presenters on today's discussion, but at any time, again, at any time, if you have questions around things, go ahead and shoot a note over to Karen and her team, and then in turn, they will be able to answer any of those questions as they come in. So that covers off on the items that I have here. I want to hand the reins over now to a great partner of ours in Bonnie Wallace. And Bonnie actually is a great leader within our financial health group, within our social impact and sustainability team. Bonnie, we have been working together, my goodness, is this 3 years or 4 years relative to this program? And so pretty excited. And I want to give you some numbers here around our numbers. Again, I mentioned we're almost at 700 registrations for today. I want to acknowledge our top referral sources. So the Hispanic Scholarship Fund, APIA Scholars, and TMCF are the top referral sources here for us for today. And then how about this? Top universities, the University of Nebraska at Omaha. Once again, they win the prize there. Also, right down the street from me here in North Carolina, the University of North Carolina at Pembroke coming in second place, and the University of Richmond connecting in. So we got some East Coast connections there, and then heading out towards the Midwest with things. So Bonnie, always an honor to work with you. Thank you for the content that you're going to be sharing. I want to give you a moment to open things up from your perspective and then introduce our panel. Then we're going to jump in with both feet. So Bonnie, we appreciate your time today.
Thank you, Dewey. Yeah, I'm reminded as we were working through our technical issues here of the last year of COVID. And, if we've learned anything, it's patience and flexibility. And so I think we got a good dose of that today. So I appreciate everybody hanging in there with us as we work through these issues. And we also learned a lot about resiliency. What does it take to kind of build resiliency so that you can withstand different types of events in your life, including your personal financial situation, right? How do you build resiliency around your personal finances so that you can withstand different types of economic shocks? And so as Dewey said, today, while we had planned this, a year ago, and the focus was really more on kind of budgeting and savings, we've built that out a little bit. And in addition to talking about savings, which is of utmost importance to build resiliency, we're also talking about investing, because for a longer term perspective, we know that you're interested in building wealth over time, and that you're not only looking at short-term goals, but long-term goals. So we'll cover some information on investing. And another thing we've learned over the last year is, while we knew that fraud and identity theft were big concerns prior to COVID, we've seen a significant increase in fraud in the last year. And the fraudsters are getting more and more creative and more prevalent. There's a lot of risk out there. So we thought, in addition to talking about budgeting and savings, we also really want to help you gain control of your financial well-being, including understanding how to protect your money. So we've got experts there as well. So I'll introduce Dr. Mia Russell. She is actually one of my teammates, one of my colleagues. She is fantastic. She is responsible for our content strategy for financial health, and she has extensive knowledge. She will focus on budgeting and savings. I encourage you to connect with her on LinkedIn, and she is a great resource for questions, but she can also connect you to many other resources. I noticed that there were some questions submitted up front about where can I go for, or where can I get information about. Mia will share some of those resources with you today, but she's also available to provide you with specific direction for your questions. I also like to introduce Sheila Jacobs, and she is with Wells Fargo Advisors. She's a managing director and market manager. She has tremendous expertise in the area of investing and retirement. So she will provide some great information for you there. And Andy Collins, who is focusing on fraud and claims management. And he's an executive with Wells Fargo, and it must be a dark place for Andy. He spends a lot of time trying to figure out where the next hole is in the armor, and how to protect our customers as well as all of you. We can go to the next slide. So I've got a polling question. We're curious, we've got a lot of people registered. We've got, quite a few attending. How has COVID-19 impacted your personal finances? We've heard a lot of mixed responses here. Has it been amazing? Have you been able to save a lot? So there's some people that haven't really been negatively impacted and are in fact in a better position now than they were before. Others are saying it's helped a little bit. I've actually spent less. Being at home kept me from doing too much shopping and entertainment, and I've saved more. The third is it's been challenging. It's really been hard to make ends meet. And the fourth one is, and I hope this isn't too common, is that it's just been devastating. It's going to be very difficult to recover. So if you could let us know, and this is anonymous, where you fall among these four choices. Well, this is pretty positive. So while it's been financially amazing for a few, the vast majority, about 3/4 of the attendees, said it's actually helped. I've spent less and saved more. And having those savings, Mia will talk to you about this, is, it's important to have some short-term savings, some emergency savings, but maybe you've saved enough where you can actually start saving for the long term as well. And we had about almost 20% who said it's been pretty challenging and hard to make ends meet. And so for those people too, the information that we'll share on budgeting will help. And it's not the best term, that everybody likes to think about budgeting. We think about it as a spending plan. And I'm going to turn it over just shortly so you can hear more about that from Mia. The next slide. All right, so I'm going to turn it right over to Mia. Go ahead, jump in.
Thank you, Bonnie. If we can go to the next slide, please. Before we really start the conversation about budgeting or building a savings plan, I think it's really important to focus on that polling question. I think it's really encouraging to see how many people have been able to take advantage of saving, but I hope that you still, there's some things that come out of what I'll share today that can help you even further. And then for those 20% of you that have found things to be a little challenging, maybe some of these tips that I'll offer can help you get jump started. So before we talk again about building a spending plan, it's really helpful to think about the thing that we all have a tendency of doing, and that is overspending. And these right here are 10 leading causes of overspending, and maybe you may have found yourself doing any of these, right? Or some of these may look more familiar than others. I know certainly during this time of lockdown and some isolation over the past year, I certainly don't want to share how much, but I have learned a lot about my spending as it relates to eating out. I didn't know that Uber Eats could become my friend, or DoorDash or Grubhub. But those commercials for Grubhub, they're pretty funny, might encourage you to look at the app. So all of us at one time or another will find ourselves overspending, right? And what's most important is to identify what we're doing and really why we're doing it so that we can then improve. Whether it's impulse buying, for example, we see that impulse buying has increased as we've been able to link our cards to accounts, right? You can be in some, there are many apps that I'm sure, or, companies you may use, you're looking for something quick and they have a one-click option. All you have to do is drop it in your cart, click, and you go. Or our phones, we just carry our phones around and you can just wave it in front of at the register, and it makes spending so much easier. So whatever your whatever is spurring your spending leak, the first thing we suggest that you do is think about ways that you can first to acknowledge it, to assess it, and then think about ways that you can change it. So just to talk about a couple here, I mentioned the impulse buying. Sometimes it's recommended that you may wait 24 hours before buying something, right? Or maybe you create some type of threshold, anything over $50, I'll sleep on it before I buy it. There are lots of ways to kind of overcome any of these challenges that you might, that may be familiar to you, more familiar than you like. Can we go to the next slide, please? Once you identify where you're spending, and how do you identify where you're spending? One suggestion is to track your expenses for at least a month. Another way is to look at all of your financial statements, whether it's a bank account or a credit card statement for the past couple of months, and see how have you been spending. Certainly, the way that we've been living for the past year is different than how you had lived if you were living in January of last year. And hopefully it's a little different than how we're living next April. But to get an idea of how you're spending money now, we should look at now, right? Once you're able to identify how you're spending, what you're spending on, then you can kind of itemize and total your income and your expenses. You should consider things that are fixed or flexible. What are the things that you have some control over? For example, if you are responsible for a car insurance payment, you might not be able to change that much unless you do some comparison shopping and find another insurance company, but you can control your groceries or your entertainment expenses. And then the next thing, or the final thing that we recommend you do, is really to monitor and control your expenses. So as I mentioned before, when we think about our spending leaks, right? Are any of the expenses that you've made or your purchases, have they been impulsive? Have any of these purchases or expenses brought you more joy or regret? Are there things that you're doing with kind of mindlessly, right? How can you make how can you spend your money in a mindful and thoughtful way? As you review, monitor, and control your expenses, and then review the plan and adjust it frequently, you're really working to create this spending plan as a living document, right? It should be flexible. There's no right or wrong way. This is your guide that supports your goals. Can we go to the next slide, please? So if we think of your spending plan as your guide to help you get to your goals, you might want to start by thinking about what are those financial goals, right? When you've identified those financial goals and why you want to achieve them, it's easier to stay motivated. And really staying motivated will help you make better decisions. So for example, and I refocused on some of my financial goals, it helped me to really make those trade-offs and reduce my Uber Eats and DoorDash and Grubhub expenses. You also want to establish and update your spending plan. Again, it should be a living document. You want to know, we all really have a rough idea of what's going in and what we're spending, what's coming in and what's going out. But it's better to work from a more accurate or a more precise document, because your financial goals are really important to you. In general, you want to think before you spend, right? I mentioned, when you think about the expenses, the money that you spent, are you happy about those choices? If you were to sleep on it, right? If you were to think about it, if you were in the store tomorrow, would you make the same choice? When you think about your financial goals, sometimes we can put our impulse spending at bay. And then think about, how can you have fun with this, right? Managing your money or staying on top of your finances can be fun, right? You may want to create a challenge and with some of your classmates, friends, or family, see who can have a no spending week, or who can spend if you all are getting together for some event, can you do it in a way where it's a potluck, or can you do it in a way where you can be challenged to spend less? And we can go to the next slide, please. So you want to build savings into your budget. And the reason that we talk about savings, especially thinking about our current context, is that having some money saved can help us avoid financial crisis. Saving is really the key to financial independence and is that starting place for building wealth. You probably know a lot about making money and spending money, definitely spending money, but how do you feel about saving money? You can think about saving money as a gift or to yourself. We also call this paying yourself first. You could think of it as a gift, a reward. The money you save has lots of benefits. Cash in an emergency, like again, COVID-19, or maybe even just the ability to reach some of your financial goals. Perhaps you're saving for college, or you're saving for the ability to buy something like a car. So of course, it will not happen overnight, but if we can make it a habit, make it automatic, do what they call set it and forget it, then your savings will grow. And right now we're just talking about building this savings, right? But as Sheila will talk about, and as you think about building wealth, this is really just a good habit for you to have. Can you change the slide for me, please? About to have a technology problem with my laptop not plugged in. I apologize. So some tips on becoming a better saver. These are just some ideas. So I first mentioned, to think about how you would feel or how you feel about the expenses, right? Does it bring you joy or regret? You may also want to ask yourself, do you really need it, or is it just something that you want? Think about how you can make your savings an automatic habit. This could be taking a specific amount out of your paycheck every month. It could be if you are due if you're due a tax refund, can you set aside a certain amount? Can you set aside any extra money into savings? Again, any type of windfall. Perhaps you may get some money on your birthday, or perhaps you're looking at graduation and you know that you may get some cash. Is there a way for you to set any of that aside? There are also small things that you can do that are very impactful, like paying your bills on time. By paying your bills on time, you reduce any potential late fees or any other penalties that you may have to pay. Make it a challenge. Can you have a daily savings goal? Some people take all the change, times have changed as I think about that. People used to take all the change out of their pockets at the end of the day and just put it somewhere and then dropped it at the bank. But, we've had coin shortages during COVID-19. But are there other ways, right? Might you be able to use coupons and save the difference? You can try to be creative. Again, a buy nothing week, or how much can I save? Some competition with friends or family. Other things similar to paying your bills on time would be to avoid alternative financial services. Also, by having savings, by having savings, it can help us to avoid the need for alternative financial services. And if you're working now or about to start employment, you're about to graduate, you want to make sure that you take advantage of any employer-sponsored retirement plans. This is almost like free money, right? If you have an opportunity to have matched savings, you want to make sure you take advantage of that. We can go to the next slide, please. Okay, and I guess I'll turn it over to Sheila.
Before we turn over to Sheila and Mia, can I ask you just a few questions?
Sure.
One thing I wanted you to touch on, could you talk a little bit more about alternative services, maybe describe what some of those are?
Sure. So alternative financial services would include things like car title loan or check cashing stores, payday lenders, right? It would be what we would consider our non-mainstream financial services. Oftentimes people use these services because they don't have established relationships at a bank. Sometimes they do have a bank account, but it may be easier to go to alternative financial service, a local establishment in their community. But often the costs for those loans are exorbitant. And so you might just want to start with your bank first, but hopefully we're trying to get to a place where you might not even need to do that if you just need a small dollar loan. Does that help, Bonnie? Do you think that's sufficient?
It does, yeah. And I know that there's also not quite as much transparency. So when you're looking at those options, you really need to be careful about, understanding what the terms are of what you're engaging in, right?
Yes.
In addition to cost.
Mm-hmm. Yes. Cost, terms, yes. Mm-hmm.
Mia, one other question, and some of this question is related to questions that were submitted before the webinar, and it's around how do you make decisions about paying down debt, saving, and then also saving for the long term. So one of the questions that came in was, should I be paying down all of my debt before I start saving? Another question was, do I need to, how much do I need to have in emergency savings before I start saving for my retirement or saving for another long-term goal?
So I know this probably will, Sheila will probably have something to say about this as well. And I guess my perspective would be that in life, we often have competing priorities. And essentially, it's important to do all of the above. So I would suggest that you consider how, that one would consider taking whatever funds they have and allocating them across the various goals, right? Budget, building an emergency savings, saving for the long term, and paying off debt. We do know that the debt likely has is costing more, right? Likely is costing more. But if you only focus on paying off your debt, then when an emergency occurs, like I think we are at a place where we shouldn't wonder if an emergency occurs, right? Hopefully it's never an emergency like we've experienced this past year, but an emergency, something will happen. And so then what do you do? So you want to be in a position such that it does not create a crisis. And so while you may not be able to pay your debt off as fast as you hope, or build your emergency fund as fast as you hope, or fund your retirement as quickly as you had hoped, over time, what we know is these small steps and this consistency works. It pays off.
Thank you, Mia. I have one more question because of something you just said. You kind of talked about the small steps, and what we often hear from college students or someone who's a new graduate is, I just don't have enough money to save right now. I can't find the money to do that. Does it matter, how small the amount is you save, or is it really about establishing that behavior?
I believe it's about establishing the behavior and really being clear about your financial goals, because while you may believe there's no money to save, I think if you do some examination on how you are spending, there may be some things that you're willing to forego for a short-term benefit, right? Or forego for the short time for a long-term benefit. There also are there are things that you can do like comparison shopping, right? Consider looking at a new cell phone provider or a new cable provider if people still have cable or telephone, right? So are there ways that you can save by just being aware of other options, right? So I think there are micro steps, and then there are some larger steps, but we do know that consistently saving and building, it will add up, and it adds up much faster than we really recognize.
Thank you, Mia. That's super helpful. And I'm going to turn it over to Sheila to talk about investing. And I shared with Sheila prior to this, when we invited her to join this panel, that the interest that we've received from college students over the last few years and new graduates in investing is amazing. It's actually overwhelming. And we're seeing people that are younger and younger interested in investing. So it's exciting. It also causes us to pause a little bit, because while it's a wonderful thing to learn about, and it's a great way to build wealth over time, we also have to be somewhat cautious about how we engage in investing. And so Sheila, I'm going to turn it over to you to provide us with some investing 101 information for our group.
Thank you so much, and I am thrilled to be here. I'm thrilled to be here for many reasons, but I will say before I jump into my subject matter, it's great to be here on Earth Day when Wells Fargo announced that right here in Catawba County, we are going to be establishing a 600-acre solar field that will provide about 50% of the electricity that we'll need for Wells Fargo here in North Carolina. So literally right in my own backyard. I'm super excited about that. And before I jump into the other content, I do, as Mia referenced, I do have some thoughts about one of the questions that was asked. And Mia talked about tracking your spending. Tracking your spending, I could also say, is being honest with yourself, tracking all of it, every dime of it. gives you the data, as Mia said, again, the data to understand where your dollars are going and to make informed spending decisions as you move forward. And one of the things that's sort of stuck with me personally over time is not a lesson from someone in the industry or from a book. It's from my mother. Every decision that we make about the way we spend either gets us closer to our goals or farther away. So I think those are some good things to keep in mind, and I want to thank Mia for that great contribution. My subject matter here again is the fundamentals of investing. So I'm going to roll through it as quickly as I can because there's a ton of good information. I'd love to hear from anyone who has additional questions later on, and my presentation will be emailed. So sit back, relax, take notes if you'd like, and I look forward to the questions as a follow-up. So I'm going to cover today why invest, what to invest in, more investment types, how to invest, meaning asset allocation, where to invest, account types, and then really quickly about a few next steps. So we'll start with obviously why we invest. And so the common sense answer that comes to mind is because folks either want to grow their money or for additional income. But more specifically, folks are usually pursuing a goal. Some of the common goals we see are retirement, education, home ownership, even helping that next generation get off to a great start. And goals are critical. The timing of goals are critical because that helps us to identify the appropriate level of risk or how aggressive we can be as we make investment decisions. Investment for retirement, even though most of our audience today is young. And I will say, I have to say a special shout out to the Pembroke folks on, because Jacobs is Pembroke area is one of those few places in the world where Jacobs will be a common last name. So I'm sure I have some distant relatives on. But investing for retirement has become increasingly important because unlike prior generations, most of us don't have pension plans that we can rely on for our retirement. So it's really on us more and more to contribute to funding our retirement. We're also living longer. And those of us born after 1960 will wait a little longer before we're fully eligible for our Social Security retirement benefits. So again, more and more important that we save for retirement. And one of the advantages of, again, I think we have a younger crowd for the most part on the call, but starting early is such a huge advantage. So again, as Mia said, so important to save what you can, so important to have clarity about your goals. And we sometimes have to make those tough decisions about spending less or sharing resources. And so saving for retirement has become super important. And also education funding. As you're probably very well aware with this demographic, the cost of education has consistently been rising and is likely to continue to do so. So we'll talk more about specific vehicles for retirement and education savings. But first, I'm going to cover some of the more widely used tools for investing. They're going to be cash alternatives, stocks, bonds, mutual funds, and ETFs. Cash alternatives are generally short-term investments like checking, savings, CDs, money market funds that are generally low risk and low return. Stocks represent ownership in a company, and those stocks have historically grown at higher rates than other investments. The value of stock investments will increase and decrease as the stock price rises or falls. Stocks may also pay dividends. That's income, meaning the underlying company shares a portion of its profits with those who own shares of the stock. And of course, companies can increase, decrease, or suspend their dividends. Bonds are debt instruments. When you own a bond, you're a lender or a creditor. The bond issuer, most often a company or a government entity, promises to pay a specified amount of interest for a certain length of time, and at the end of a certain length of time to return the principal. Mutual funds, which may be the ideal vehicle, again, for a lot of the folks that we have on today's call, are professionally managed portfolios. They're bundles of securities like stocks, bonds, and cash. Mutual funds also invest according to a specific investment objective, like aggressive growth or conservative income. And the best practice here would be to align your investment objective. If you're young, you're saving for retirement, maybe aggressive growth is appropriate. So you might want to seek out an aggressive growth fund for those needs. So aligning your objective with the objective of the mutual fund may be helpful as you pursue your goals. Mutual funds may also have a lower barrier to entry than individual stocks and bonds. Some allow investors to begin with only a few $100s, or to do a systematic saving and investment plan, maybe $100 a month or $500 a quarter. So they can be really useful, again, with our newer or younger investors. Exchange traded funds, or ETFs, are designed to track a specific index, like the S&P 500. The S&P 500 index is an index that measures the stock performance of 500 of the largest companies listed on US stock exchanges. The manager of an index will purchase a basket of securities that's designed to mimic the index. And unlike mutual funds, ETFs aren't generally actively managed. In other words, once the securities are purchased, the manager does little or no future buying and selling, and that can lend itself to lower expenses than we might see in mutual funds. Like stocks, mutual funds and ETFs will absolutely fluctuate in value. Again, that's why it's so important to have that vehicle that is aligned with your investment objective. Going really fast, trying to get it all in. We'll touch next on how to invest, or asset allocation. We'll hear folks say, well, we can't have all of our eggs in one basket, right? So we don't want to be all aggressive all the time. And we've done a really high level of some of the most overview of some of the most commonly used investment vehicles: cash alternatives, stocks, bonds, mutual funds, ETFs. And a natural question would be, well, which one is right for me? All investors want high growth, liquidity, low risk. And unfortunately, it's a tricky situation to find one investment that'll offer all of those. Cash alternatives tend to be less risky, generally don't offer much in the way of growth. Stocks, stock mutual funds, ETFs can offer growth potential, but they're certainly going to fluctuate. There can be some volatility. Bonds can offer a higher rate of return than cash, with less volatility than stocks generally, but they're really meant to be held to maturity. So liquidity can be an issue. And so what many investors do when we talk about asset allocation is combine certain investments in the appropriate ratio, again, to align with your personal investment objective or goal. For example, an investor with a longer time horizon, maybe more than 10 years, might consider investing 75% in stocks, ETFs, or stock mutual funds, with 15% in bonds, and maybe 10% in cash alternatives. An investor with a medium-term time horizon might invest 50% in stocks and 40% in bonds and 10% in cash alternatives. And then we think about where to invest. It's not where in terms of which door to walk in. It's more of an overview of some of the widely used account types, things like individual retirement accounts, or IRAs, or employer-sponsored retirement plans. Those are, as they state, retirement vehicles. For education, maybe 529. So we'll take a quick look at those and hopefully have lots of time for Q&A. When we talk about individual retirement accounts, we generally talk about traditional or Roth. Traditional IRAs allow individuals to contribute as long as they have earned income. Contributions may be tax deductible, and offer potential tax deferred growth. With Roth IRAs, individuals can contribute as long as they have earned income and meet certain income requirements. Contributions aren't tax deductible, but Roth IRAs offer potential tax deferred growth and tax-free withdrawals as long as guidelines are followed. Roth IRAs might be ideal for folks who are concerned with what tax rates might be later, and so they'd prefer to pay the taxes now. Jumping really quickly again into employer-sponsored retirement plans like 401ks, 403bs, even some SEP and simple IRAs. Those allow an investor to reduce taxable income while saving for retirement. Some employers may even match your saving up to a certain level. Roth options can be available, and IRAs and employer plans will provide a catch-up contribution for those over 50, meaning if you're over 50, you're able to save a little bit more each year. Moving on from retirement to education savings, I want to take a glimpse at 529s. 529s for education savings offer a lot of benefits. You can use up to $10,000 per year toward elementary and secondary tuition. They offer potential tax deferred growth. Tax-free withdrawals are available for qualified expenses like tuition, room, board, fees, books. They're professionally managed. In complex situations, they can also even be used for estate planning. Beneficiaries can be changed. Beneficiary in this case being the student that is initially identified. If there isn't a need for the fund, maybe there's a scholarship and another sibling needs those dollars. And there are some state-specific benefits to choosing one plan over another. So you'll want to be sure to do research and certainly consult your tax and financial advisors, especially when you're thinking about changing beneficiaries on 529s, because there's some rules around how closely related you need to be to do that without tax consequences. And then as I close out and thinking about next steps, I don't think I can overemphasize the value of a plan. Whether you take notes on a piece of paper, whether you create a vision board, in my opinion, and I've always thought that the vision, what we visualize for our future, is really the roots from which our goals grow. And then we can put systems in place, as Mia referenced, to allocate certain dollars to each of our goals. And based on the time horizon that we have, make wise decisions about how we then invest those dollars. So make a plan, make a plan, make a plan. And then again, have real clarity around your vision. What does success look like for you? I remember very clearly when I was younger, success for me, for my mother, looked like me being a lawyer, right? But that wasn't my vision of success. So really have clarity around your vision, because if you do not, as you pursue your goals, you'll always feel a little bit torn, and our spending is very emotional. So create goals that are specific and personal to you as possible. And I think we'll have some time for Q&A. So I want to thank you for this time and your attention, and I look forward to your questions.
Sheila, thank you so much for that. And I think it's probably, I'm stating the obvious, but the topic of investing is so broad.
Yes.
And there's people that study for years and years, right, the topic. So we've pushed a lot into about 12 minutes. Hopefully this generated some interesting questions for the audience. And we would be happy to provide you with additional resources. But there is one question that I have for you that we often get from college students and college graduates, which is, how do I get started in investing? Should I be thinking about this in terms of practicing my own skills and knowledge in selecting stocks and determining how to invest independently? Or should I be doing it the way they described as more passively, working with an expert who I'm going to give money to and they're going to invest on my behalf? How do you think about that?
Well, I'd say yes to both. I think that any opportunity that we can have to learn from the experts and you'll find all you have to do is ask. Most experts will be happy to help you and offer some advice and guidance. And I think it's equally important to always, even when you become a little bit more of a seasoned investor, start to educate yourself continually throughout the process. It is a journey. And even though we have a vision now and we have stated goals now, we know that they will change. So we'll need different experts at different points in our life. So I will tell you what I did as a 22-year-old person is I asked a friend for advice. They directed me to a financial advisor. And I will just add that by the end of that meeting with her, I knew what I wanted to do next for my career. She was thoughtful and kind, answered all my questions, made a solid mutual fund recommendation that became the foundation for my personal portfolio. And I think you'll find lots of folks like her willing to help and contribute.
Thank you, Sheila. And now, I'm going to turn it over to Andy, and Andy's going to share with us some of how he thinks about fraud, which is all day, every day, right? And some of the common fraud scams that are out there and how to protect yourself. Andy?
Bonnie, I appreciate that. And yeah, as you referenced earlier, I'm coming to you from a dark place. Every day I get to see the ugly underbelly of crime and the exhaust of it. And I can tell you, I work with a great group of folks at Wells Fargo who work every day to help stop this crime. And then even today, I'm speaking to you on the heels of having to clean up a fraud event perpetrated against my own father, my own elderly father yesterday, who was unfortunately caught in what's called a grandparent scheme. And it's actually, and sadly, the second one he's fallen for. So I'm actually a little more sensitive and passionate about this content today than I even would have been yesterday. But let me just start off saying that we all have a common problem, and that's that fraud actors are becoming more sophisticated. And I know I'm old enough to remember the days when the biggest thing we had to worry about was counterfeit checks or counterfeit payment cards. But there's a lot of counterfeit card risk mitigated with the advent of chips and debit cards. So you all have a chip in your cards now. Counterfeit checks are still out there, but a lot of the in-person issues are starting to really subside. And so the bad guys are having to figure out, well, where do I get money from? But fraud's more sophisticated today. I mean, when you think about who fraudsters are, who are the fraud actors, and in some cases they can be large organizations, they can be global conglomerates. I mean, envision a huge warehouse-sized call center operating in a poor country, and they've got local management teams, they have success metrics, they have personal performance measures. I mean, as bankers, we have to worry about state-sponsored fraud cells, domestic fraud cells, local gang networks, and then, some teenage kid who's in his garage, trying to use stolen cards numbers to be able to buy games or other items of value with games online. And so what's happening here in terms of to make the fraud actors kind of go crazy? Well, first of all, consumers, we all have begun to demand and have for a while that money move at a faster pace, right? Mia was talking earlier about how spending is easy, and she's right. Spending is easy, and also the methodology for spending is easier. Banks and financial service companies have really made it easier and to be able to meet that demand that the consumers had. So, rightfully so. I mean, consumers, you and I, we all like, we want the convenience of cash without cash in the wallet necessarily. I mean, things like Venmo and Zelle and Apple Pay, they're great features. And I love to be able to go to the store, store my payment device in a digital wallet so I don't have to worry about the payment. And I love to go to Chick-fil-A and pull up my phone instead of, having my card disappear over a counter and not know what's going on. But see, a lot of those conveniences have been built with the consumer in mind first and fraud in mind second. And so a lot of new fraud controls, they deploy at a slower pace than the money movement innovations themselves. And so as a result, banks and other companies have tended to work to catch up to the fraud actors instead of being ahead of them. I can tell you that we're, as financial institutions, we're getting better. We're getting much better. But there's some other inherent weaknesses that I want to talk to you about then today as well. If you can go to the next page, that'd be great. So when you think about what kind of fraud is out there, I've kind of given you a little bit of flavor on this particular page. And impersonation, which was 23% of all scams last year. That's where a scammer is contacting a customer via email or phone or text and claiming to be from an organization such as a government agency and so forth. This really increased with COVID, and Bonnie had made reference to increasing fraud. There's so many different scams out there with COVID, and they actually lead to purchasing scams as well. So think about that. Think about the great 2020 toilet paper chase, right? and the N95 mask shortages. Anything that was in short supply relative to the emergency, fraud actors were happy to take your money with the promise of sending a supply right over. And then they do the same thing, unfortunately, with other emergencies, even outside of COVID, like with hurricanes and this kind of thing. They're all over any type of emergency. Account takeover, that was actually, you can see there, 22% of all scams last year. Fraudsters, they steal information and passwords, usually from the customer through phone spoofing, for an example. One-time passwords are all too often freely given, and that gives the fraud actors the keys to the kingdom in terms of wiping out individual customer accounts. And so there's been a big shift here. Fraud actors have really seen the consumers, and let me say that again, fraud actors have actually seen the consumer as being the weak link in the chain. Used to be they picked on the banks a lot, but they're really picking on consumers now. And when it comes to scams, I'm talking to you about that because generally speaking, if it's a scam where you have given your information away, a password or whatever the case may be, you may well be and likely are liable depending on the scenario. So it's important to make sure you understand that. Investment scams, we just talked a little bit about that, but those are a little more like employment scams or other types of Ponzi schemes. Any unrealistic opportunity that is likely to cost an unwitting consumer more than they've earned. And the last one I'm mentioning, and it's on the short end of the list here, but it's like romance scams. Romantic interest online. So you meet somebody online, you fall in love, so to speak, and then they've tapped into your emotions, and then they work to manipulate you into sending money at some point when they develop that trust. Now, this is really, this preys on a lot of very vulnerable populations. And when you think about lockdowns, we've been locked down for a year, it's really, the isolation makes folks lonely. And so they become more susceptible to this type of fraud. So anyway, the process flow that you see on the right there is kind of typical of a fraud scenario. In some cases, it's what we call first party fraud, or a true fraud actor. In some cases, it's a third party who's trying to get the information or promising you something. And so let me just be really clear about one thing though, because I've got on there that data or information is power, and it is. They already have your information for the most part. There's been so many compromises out there, and there's so much information flying everywhere. They probably have your information, but they don't have everything they need to steal from you. They kind of rely on you to be able to fill in the blanks. So let's go to the final page if we could. I put together I have a top 10 too. It's the things that you should do to help protect yourself. And when you're coming out of college, or when you're just trying to earn money for the first time, this is an important component, because you may well find yourself in a situation where maybe you're feeling a little bit of desperation, or you're feeling a little bit of how can I make more money? You got to be careful about what it is that you're doing to be able to get that, because this is where the fraud actors also will tap into those vulnerabilities. But the top 10 list is really this. So, and I put them into words and quick phrases that maybe you can remember this, and this will be shared with you also. But don't call me, I'll call you. If there was one thing if I could say to the entire country right now, I hope this goes viral, at the same time, is stop sharing your passwords or your one-time passwords with people who call you. Right? I'm constantly stunned at how many consumers are quick to relinquish this information to a fraud actor who will call them. And they do it in a rather shrewd ways. They'll imitate the bank. Looks like the bank's calling, but the phone number is spoofed. And so, but don't share that information unless you've called the bank and then they're trying to verify who you are. They're not going to ask you for that information. The second one is wait, don't push that button. Email links are the most common methods for extracting information from scams. As an example, I've seen many people lose their life savings, literally their life savings, on mortgage transactions where malware on their home computer, or it could be on their title company's computer, or the fraud actor basically changes the funding instructions during a mortgage closing, right? And so if you push that button, you could be putting some pretty malicious stuff on your computer. And once that happens, all the bad guys have to do is just watch and see what kind of transactions you have flowing through, or the title company, and then change the instructions to some, you're going to wire money instead of the title company to someplace in China, and then the money is pretty much gone. I've just seen that too many times. But don't push the buttons. Those buttons that are on your computer that come in the form of links. Don't push links. If you're really interested in that email, go outside of the email. It may sound extreme. Go outside the email. As you're an expert at URLs, go outside and then just go look it up yourself. The next one is run faster than the bear. Fraud actors are always dreaming up new MOs for different types of cyber or malware. Tech companies always release new security. You see this on your phone all the time, right? Update your phone. Do that. Keep that phone and your computers updated. Otherwise, you're missing out on their new mitigation. So run faster than the bear and keep all your phone and computer updates current, and also keep your antivirus current as well. The next one is bring out your creative side. Use creative passwords like phrases and with interlinked numbers, like my dog had 56 puppies! ! I mean, just something that that is easy for you to remember, that perhaps you don't have to write down. But also, if your bank offers what I call persistent multi-factor authentication, so I have to put in a one-time password every time, sign up for that. Give yourself the last word on changes or money movement in your accounts. The next one is verify but don't trust. This is actually closely linked to the first one. I mean, there are literally apps on the various app stores that I can download today, and I can turn my caller ID into whatever I want it to say on your phone, like Wells Fargo or Bank of America. And I think one of the links or the apps I saw recently was fool your friends. It's going to be funny. So not funny. Never trust caller ID. That's the point there. Never trust caller ID. Next is stop, freeze. Another repeat, but manage your own credit. This is your credit report. Freeze your credit bureau report. Think about this. How often do you really use a credit bureau report? It's really only when you're applying for a loan. When you're applying for a loan, you can actually release the freeze and then put it back on afterwards. That's important because if you have a freeze, it's going to prevent a fraud actor from opening an account in your name, right? That's important. It's one defense that few people take advantage of, but especially at your age, make sure you do that. Never give out, of course, your passwords to release your bureau freeze. Next few here are, you must not act now. So slow the game down. Don't let some guy or some bad actor press you into moving quickly, or time-related offers, right? If you feel uncomfortable, slow down the game, verify it, outsmart the fraud process. Next one is bet with chips. If you can use your card chip, always use it. Sometimes I know you can't. The mag stripe though, and that strip in the back of the card, it's very, very vulnerable, and it has your card information on it. And so if you swipe it, it's very well likely that somebody could be watching you with a little mini camera and then making sure that they can get the information from you. So use that chip that actually changes codes inside of the transaction with every different transaction. Last two, if you feel lonely, get a dog. Now, I say it lightly, but loneliness I know is a horrific vulnerability, and the title's not meant to make light of it, but rather something to remember it by. People who are lonely are susceptible to romance scams, friendly fraud, elder financial abuse. Reach out to lonely people too. This is well beyond the dog. The human touch has much value, but make sure that if you're feeling that way, get with somebody and try to break out of that rut of loneliness. I know it's easier said than done, but the bad actors, they target that vulnerability more than any other. And then the last one is actually what you're doing today. You're listening to me, rattle on. Know the game. Keep up with the bank's website, which most banks' website will have the latest in fraud trends. And there's other resources where you can educate yourself. The FCC has a nice website. The FBI has a nice website. Things that are happening, ways to be able to protect yourself. An educated consumer is their own best friend, and knowing fraud methods will help you avoid fraud and not be a victim. So bottom line, y'all, banks and consumers, we're all losing billions. Banks and government entities and businesses are relying on the consumer to help themselves, and the consumers relying on banks and government entities to protect them. Truth is, we all have our role to play together, and the more effective war is actually waged as an army, a single army, not just individual components. But the truth is, there is nobody that can protect you better than you. And so if you'll take those top 10 steps and apply them in your life, I think you'll find you'll be in much better position to protect yourself.
Andy, thank you so much. I love these top 10 steps. And as you were discussing them too, I was thinking it'd be a lot of fun to animate them somehow. Some animation behind that, or get you a book deal. Okay, one of the questions that came in is just, could you remind us what an ATO is?
Yeah, it's an account takeover. ATO is account takeover. I'm sorry, if I used acronyms, my apologies.
Thank you so much. Hold on one second. Thought we had another one here. One second. Okay, I've got one as I'm trying to find the one that is on about fraud. I've got one for Sheila and Mia, if you could both comment. I thought this was a great question, and it's, where can I go to get someone to help me construct a plan or to talk to me about a plan? Is that something I can go to a bank like Wells Fargo to do, or are there other resources?
So I hopefully I answered that in the chat as well. I do apologize. I'm trying to get to as many chat responses as I can. But the answer to the question is yes. In most of our branches, we have financial advisors who are assigned to that location. Especially right now, though, it's probably best to make an appointment because some of our folks are still working remotely, but absolutely. And I would encourage folks to speak to those financial advisors, to be really clear about where you are in your educational process or your journey as an investor. Just be really candid and frank, and maybe even talk to a few of our Wells Fargo advisors because you click with one versus another. So I encourage you to make the call, make an appointment, and go in, and hopefully you have a great first relationship, but talk to a few and maybe get a couple of different perspectives on where you are and where you need to be.
Thank you, Sheila. Mia, do you have anything to add?
Yeah, I would add that you may find an accredited financial coach or accredited financial counselor in a local community-based organization in your area, or you could also check out a website, afcpe.org. I can also put that in the chat to learn more about, to find out where there are some coaches that can help you, oftentimes for free or at a very nominal charge to help you get started.
Thank you, Mia. And Andy, I've got a question for you. It's a little bit of a two-parter. We don't have too much time, but we know that the audience that we have today is they're probably using peer-to-peer apps like Venmo and Cash App, and also probably engaged in a lot of online payments. And we had a few questions about, how do we keep ourselves safe with those peer-to-peer payment tools and with online transactions, for example, with Amazon?
Yeah, and I just answered the question on Amazon. Amazon is an example, or any other type of wallet. They're generally pretty safe. They store your cards. You have a good, if you keep your passwords tight there, keep them varied so they're not the same password as you have on social media. Don't put your name of your dog on there, right? Don't put your birthday on there. So be creative with those passwords. And then in a lot of cases, those third-party wallets will send out one-time passwords, especially when there's some sort of activity that they think is questionable. a lot of times what will happen is that fraud actors will literally call you up and they'll say they're from Amazon, they'll say they're from Wells Fargo, they'll say they're from Apple, and they'll convince you to try to give them that password. And then what they'll do with that is they've already accessed your account somehow, and then they'll just have the ability to be able to move it. Keep anything that goes into your phone from a one-time password perspective private. Don't give it to anybody. They're not going to ask for it. When the IRS calls, they're not going to ask for it. I mean, it's really up to you to keep it as safe as possible. And above all, when it comes to any type of authentication, don't trust anybody.
Thank you, Andy. And so I'm going to ask one last question. I'd like you each to answer. You're going to have just a few seconds, 15, 20 seconds to answer. But we've all had some hard lessons that we've learned in our own financial journeys. So if you can kind of quickly share what your financial lesson is and what advice or ideas that you can share with the audience so they don't repeat our own mistakes. You want to start, Sheila?
Yeah, my mic is open there, so I'll jump right in. And I'm going to talk really fast because there's one question that I said I was going to answer live. So the best lesson I got was I started working at age 14. And we didn't have a ton of money. And so I just decided I'm working, I'm going to buy anything and everything that I want. And so my mother started to take away my money. At the end of the weekend, I worked on the weekends. She would take my money and I was very upset. And then a few months later, she handed me back my savings statement and there was $1,000 there. So that was a lesson that I appreciate, again, referencing my mom. But we had one quick question about someone receiving an inheritance and asking if they could put that in a Roth. And I want to answer that live because I think it'll help a ton of people. Roth and traditional IRAs have annual limits. For 2021, the limit for people under age 50 is $6,000. So certainly you could put some of it into a Roth. If you haven't done last year's taxes and filed them yet, you could put 6,000 for last year and 6,000 for this year. And certainly then all of these other investment decisions are led by your goals and your time horizon. That's the answer to so many of the questions. So please, please, please always go back to that. What is my goal? How long do I have? And then where is it in terms of the ranking among my other goals? A lot of good questions came in and that was the answer to a bunch of them.
Thank you, Sheila. And also a good idea to talk to the experts or someone to help you with your plan because they're going to ask you those questions over and over and over again. Thank you. Mia, a lesson.
Yeah, I think that I do this type of work because I made lots of mistakes. And so maybe the biggest lesson is that we get do-overs, right? And we should continue to try, right? Not get ourselves, not beat ourselves up for maybe making a decision that we, that didn't turn out the way that we had hoped. So I would say recognizing that in life we'll make a mistake or two or a few, and to keep on pushing towards those financial goals, as Sheila mentioned. So give yourself a little bit of a break. Maybe that's it in a nutshell.
I like it. Thank you, Mia. And Andy?
Oh man, I hate telling myself here, but actually Mia's top 10 list, I violated every one of those rules many times. And I think the worst one was getting into debt as a young person. And as my wife of now 33 years likes to say, the first 5 years of our marriage, we were actually paying off your dates from the previous, 5 years of your dating. And so, my biggest, I guess, tell on myself is do not use credit cards that way. Don't get in debt with credit cards. I mean, where my credit card partners at, they're going to kill me. But, credit cards, I'm all for using credit cards in a prudent way. I'm not sure they're probably the best way to be able to get yourself in debt, though.
Thank you, Andy. Thanks so much to the audience. I'm going to turn it over to Dewey to wrap us up.
Hey, Bonnie, thanks a million. And what great information from our wonderful panel. And so as an action item, scholars, and to anyone that's listening to the playback, please take time to go ahead and reach out to all of our partners. You can find each of them on LinkedIn, and you can certainly continue the conversation. Tons of good information. And again, listen to the playback of this session often, and I guarantee every time you'll extract something new from it. So Sheila, awesome job. Dr. Russell, thank you so much. Andy, great job. And round of applause for Bonnie Wallace too. She is one of the best in the business and a great partner of ours in all of this wonderful work. So, hey, listen, we're going to close it out over the next 90 seconds. On the next slide, you'll see our reminders here for today. The webinar series is going to be continuing, team. We've got great details here. We now have, my goodness, 5 completed for the year with 7 more to go. Don't forget, jump over to the API Scholars YouTube channel. You can access the playback for all of the sessions that we've covered off on here for up to this point of the year. Share the information with others. Use that hashtag WFC Beyond College to pay it forward for others that may be interested in the information. I'm going to stay on this slide for a moment. Please, everyone, highlight in yellow or pink highlighter, July the 29th. This is our largest event of the year. We had over 2,100 registrants last year to learn about careers and internships within our firm. Many of you all may be preparing for your internships that are going to be coming up a couple of weeks from now or over the summertime frame. So please join us for that session on the 29th, and we'll continue, I promise, to share more and more great information as the year continues. The next slide will just give you some reminders. You'll also get this one via email when we send back the playback details. Give us feedback. We're always interested in feedback. And again, thank you as we overcame the technology little snafu here for a little bit today, but give us feedback on our process. Give us feedback on the content that was shared today. We want to know those things so we can continue to refine and build great programming in the days ahead. So utilize that link there to give us feedback when you get a free minute. On the next slide, don't forget, stay in contact with us. These are really great resources, whether it's the Beyond College webinar series, whether it's our great partners over at Tuition Funding Sources. They're the great folks that send out our reminder emails and details relative to these great events. Go ahead and get connected with the resources available through TFS, and please take time to join our talent community and also connecting with our great partners over at the university programs area. The next slide will just give you an overview. The talent community is the place to be if you want to learn about career opportunities. Of course, if you want to be able to do keyword searches for roles that may be out there, join the talent community. This is a great way for us to share information with you about career opportunities that are available within our institution. So please get connected there. With that said, I want to thank all of our presenters today for the wonderful, wonderful information that they shared. Sheila, thank you again so much. Mia, Andy, Bonnie, just a wonderful, wonderful job. We cannot end this call without acknowledging again our great partners over at APIA Scholars. Karen, special thanks to you and to Nicole and to the entire Dream Team for your work on this series. Also want to give a big shout out to Barbara Scotland and Andrea Vienna and other partners across from Ashley Rasmussen as well, who's helping us get this information out. So with that said, we'll just remind you to join us again next month. We're going to be in May, before we know it, guys, on May the 20th for a discussion around entrepreneurship. And I would encourage everyone, when you register for that webinar, go back and listen to the playback of this one. A lot of the content that we shared here this month is going to move seamlessly into the things that we're going to be focusing on for the month of May. And Bonnie, you're coming back with us for the month of May, right? If I'm not mistaken, don't we have you on tap for the May discussion? I think we
believe so. I believe so. I've got to get off this call and get busy planning the next one.
Listen, and we're going to, Bonnie, we're going to double your speaker fee the next time
Awesome.
around. How a triple?
Awesome.
How about
I'm
triple?
going to work with Sheila to invest it.
I love it. I love it. Team, thanks again. Thanks for the flexibility. Again, for everyone listening to the playback, thank you so much for joining. We'll